Hey everybody, we're back with yet another topic that we hope is helping you on your real estate journey out there. This topic is what is in your payment. People tell you things like taxes and insurance and principal and interest and MI or PMI. There's a bunch of lingo that's there, and we want to provide some clarity on when you write that check to your financial institution to be able to pay the payment for your house. How is that built and what's there? Now there's a lot of information here to unpack. And what I'm going to try to do is keep it as simple as possible, and what we may do is delve into some other elements of this in other videos just to keep these short and simple. In case you don't remember, I'm Matthew Paden with the Paden Group at ReeceNichols iCapital Realty. I've got 13 years worth of experience. I have a team of 4 which is happy to help you with any of your questions, so make sure you reach out and you let us know topics that are important to you inside this real estate journey. So back to the topic at hand. What's in the payment? Let's start with talking to your lender. Remember, we've already told you, make sure you have a lender partner that's not only working with you, but is also working with your agent. It's critical that they work together inside this process. So we start with the principal and the interest. That means I bought a $100,000 house. I have 6.75% interest. If it's fixed, those things don't change. So you have your principal and interest payment that stay the same. So something you can count on, which we all like. What's next in building that payment? Well, what's next is your escrow. What is that word and how does that work? Well, we'll dive more into some escrow stuff, but let's start with how it counts on your payment. During the process of buying the house, you're going to be talking to someone that'll help you insure your house, as well as you're going to be buying a house that has a certain amount of property taxes on it, called real estate taxes. Well, the lender will take that information and put it into a calculator and tell you what your escrow payment is. That lender has to keep so much money inside their account to make sure that as your payments in that escrow land ebb and flow, that they have enough in reserves to be able to pay anything that they're short on. So essentially, they're holding a savings account for you. Nearly every single loan that we do has this escrow in there where your insurance is built into it and your real estate taxes are built into it. And when those bills come due, your lender makes those payments for you and you don't have to worry about it or think about it. Do you have to do it in every loan? No, not really. Is it encouraged? Absolutely. It takes it off the presence of mind and they take care of it. Now people say, I have a fixed rate. Why does my payment change every year? Well, come around March, you should get a letter in the mail that tells you, hey, your payment's good, don't worry about it. Hey, your payment went down, that's rare, right? Or hey, your payment's gonna go up, and you might even have a shortfall amount that you have to pay to help them get their reserves back where it needs to be, okay? That means something happened. Your real estate insurance went up, right? Or your real estate taxes went up, or both went up. If they did, that means your payment's going to increase so that the reserves with the lender stays where it's at, and the lender has enough money to write the check for you when your bill comes due. Now, I know all of this sounds like, gosh, Matt, there's a lot, but there's one more that can go into a payment. As you're making your choice as a family on how much money you're going to put down on your loan, anything that's 20% and above, so 20, 25, 35%, you don't have what's called MI or PMI, private mortgage insurance or mortgage insurance on that loan. Anything that's 19% or below will have mortgage insurance. Now, what is that and why is it a part of your loan? Well, in this world, it's a part of your loan because the bank is covered by the government on if you default on it from 80% and below. They are not covered from 81% and above, so they have to carry mortgage insurance on it. Well, who gets to pay for that? You do. And so that's a part of that process, and you'll find out from your lender that could range anywhere between $50 to $175 extra a month. Does it stay on there the whole time? Well, in certain loan applications, it'll stay on it for life. In other loan applications, it falls off, and it's supposed to fall off at 80%, but if you don't call the lender and tell them you're at 80% what's called loan to value, it'll naturally fall off at 78%, and that part of the payment will go away and your payment will get cheaper. Now gosh, I know this is a lot to take in and I understand. So if you have any additional questions, be sure to leave those down in the comments. We'll address those. And of course, like I said earlier, if we aren't touching on the topics that you want to hear, we want you to leave those down in the comments as well. It helps give us energy to what's happening here. Speaking of energy as well, if you're on this journey by yourself, we would love to help you. You can also reach out to us in the comments also. We hope you have a blessed day.